Hello and welcome to another episode of the Golden Thumb Rule, where we decode complex investment concepts and bring them closer to everyday investors. Well, I'm your host, Kshitij Anand, and today we are diving into a brand new regulatory category that's beginning to capture attention in India, which is specialized investment funds, popularly known as SIFs. Now, to help us break this down, we have with us Bhavesh Jain, who's a co-head and factor investing at Edelweiss Mutual Fund. Bhavesh, it's a pleasure to have you on this show.
Thanks, Kshitij, for having me.
Thank you so much for taking the time out, Bhavesh. And for listeners who are, familiar with mutual funds and AIFs or, the alternate investment funds, what exactly is a specialized investment fund or SIF, and how does this regulatory category carve out a differential space in the Indian investment landscape?
So if you'll see, a lot of our investors are very well aware of mutual fund. It has a history of more than, you can say, 30 years now, an AUM of more than 75 lakh crores. PMS, on the other hand, again, is quite popular. We have history of more than 20 years over there. AIF last almost 13, 14 years now. But if you'll see, there was a huge gap in between.
Sure.
A retail investor can come with 100, 200, 500 rupees in mutual fund. But if he has to upgrade himself and move to PMS, the minimum ticket size was 50 lakhs. And for AIF, that was 1 crore. So that was a huge gap which needed to be, you can say, in a way, catered to. And that is where SEBI came up with this idea of SIF. So SIF, I will say, is a product which is nothing but an additional scheme of mutual fund, but with some additional features. So as I said, additional feature, this is the first time where mutual funds are allowed to take a directional short position in derivative.
Sure.
This is the first time where, if you will see, most of the category have given full flexibility. There is no market cap based, you can say, definition that minimum large cap, mid cap, XYZ percentage should be there. It is not there. So a category where fund manager will have maximum flexibility to express his view. And from an investor point of view, a retail HNI client slowly can upgrade himself to a category which is not similar to, we can say, what an PMS and AIF will be, but much closer to them as far as flexibility is concerned, because use of derivative and taking open, you can say, directional position both on the long as well as short side is allowed. But the most important part of it, it is taxation wise, it is still a part of mutual fund. So entire mutual fund taxation, which is section 1023D, is applicable to SIF also. So in a nutshell, if you have to tell to anyone, SIF is just another scheme of mutual fund with some additional flexibility available to the fund manager, but taxation wise, it is same as a mutual fund.
Absolutely good that you brought on the taxation part, because I wanted to, understand from you is SIF has a, sort of a tax efficient structure where long-term, or the LTCG, you could say that long-term capital gains with a holding period of more than 24 months are taxed at 12.5%. So how does this specific tax structure work, and why is this 12.5% LTCG rate the golden thumb rule, you could say, that makes the SIF framework potentially more attractive?
If you will see, in SIF, there are three categories of products which have approved: equity, debt, and hybrid. And taxation is similar to what mutual fund have. So any SIF which is having more than 65% equity will have equity taxation, where long-term capital gain tax of 12.5 will be applicable after 12 months. For a fixed income strategy, it is similar to fixed income. There is no concept of long-term and short-term. Whatever your gain will be there, it will directly add to your income and you will be taxed as per your slab rate. And the third category is like hybrid fund, similar to mutual fund. Some hybrid fund, if they have more than equities of 65%, like an arbitrage fund or a balance advantage fund. Similarly, in here, there are two hybrid products. If your equity is more than 65, again, you will have same equity taxation, 12.5 after 12 months. But if your equity is less than 65, that context, your taxation will be 12.5% after 2 years. Now, as I said, flexibility wise, you are getting a product which is closer to AIF. But taxation wise, it is a product which is similar to mutual fund. So if same fund manager running an AIF will be subject to, you can say, tax rate which can be as high as 39%, whereas the same fund manager managing an SIF, similar strategy, his taxation can be as low as 14.5 to 15%.
So you discussed about the three categories of funds, and let's focus on the hybrid one. So how does the hybrid funds work, and who should ideally sort of invest in this specific category?
Sure. So within hybrid, the regulators approved two categories. One is similar to your multi-asset fund right now, wherein you can take exposure to equity, debt, gold, silver, REITs, InvITs. The flexibility part of an SIF over an MF over here is today in mutual fund, all your multi-asset fund can be long only multi-asset. That means you are long on equity, long on debt, long on gold, long on silver. Numbers can be plus minus here and there, but everything is long. In SIF, same fund manager, if he's negative on equity, he's not forced to have long equity, he can have short equity. If he's negative on interest rate, he can actually go short on debt. So that is the additional flexibility which will a fund manager will get into an multi-asset, you can say active asset allocator, SIF, hybrid SIF. The second product is hybrid long short fund, the product where we are coming up. We are already come up with an NFO from 1st of October. That product is hybrid long short fund. The ask over here is very simple. Minimum 25% has always to be there in equity and debt. But the flexibility part again is this 25% equity can be equity long, can be equity short, can be arbitrage, entire your choice. And remaining 50%, the fund manager is free to move either in equity or in debt, long position, short position. The only common thing for all 7 SIF, not only hybrid, all 7 SIF, the only thing is maximum short position, directional short position can only be 25%. That is applicable to this category also. So that means I can run a product where I will run almost, you can say, arbitrage plus special situation plus some derivative position and debt, and try to generate returns which are much better compared to a normal arbitrage fund where you can only do cash future arbitrage and debt. Here you can add a couple of more things like special situations and a lot of derivative trades, and then effectively get that 2 to 3% extra compared to an arbitrage fund. So this is an ideal product for all your fixed income investor, all your arbitrage investors, all your cat 3 long short AIF investor. And then, as I said, the entire, you can say, investor base, which is right now sitting only in fixed deposit. So you can target those kind of, you can say, investor also through this product.
Where should an investor strategically place an SIF in their overall portfolio? Or you could say, how much percentage of the overall corpus should be allocated to SIF?
See, this again depends on individual to individual basis, his risk return profile and his liquidity requirement. But ideally, if you will see, this is an absolute return strategy similar to what an arbitrage fund or what a fixed income investor will get. You are not dependent on market direction. See, though, if you will ask me today, each and every client will normally keep 20-25% of his portfolio in fixed income, either through meet his emergency need or some short-term expenses. So I think a sizable portion of that at least should move into an hybrid long short SIF.
Absolutely. And also, there are too much of aberrations going in the market. We have SIFs, we have AIFs now, PMS or MF. So, so how should one differ, between these traditional investments? So how does SIF differ from AIF, PMS, and mutual fund, just for the understanding of the investor base?
As I said, the most important part is your entry ticket size. MF, one can come with, as I said, as low as 1,000 rupees, 5,000 rupees.
Exactly.
Then PMS was directly at 50 lakhs and AIF was directly at 1 CR. SIF, you can start with 10 lakh rupees. But there is a small catch. This 10 lakh is per PAN per SIF. So for example, as I said, there are 7 categories which are approved. So today, because we only have one product, you have to start with 10 lakhs. But tomorrow, when we will have 3 or 5 or 7 products, this 10 lakh has to be divided into this 5 or 7 strategies. So you can actually come up with as low as 1.5, 2 lakh rupees also. Second, the most important part is taxation. In PMS, taxation is at transaction level. Every time a fund manager will buy and sell a stock, he will be subject to taxation. And AIF, taxation is at fund level. So though he don't pay transaction level tax, but at fund level, irrespective of the client redeem or don't redeem, at the end of financial year, the fund has to pay a tax. And that tax can be as high as his business income, which can go up to 39% also. In SIF, it is similar to mutual fund. As I said, Section 1023 benefit. Mutual fund and SIF are a pass-through vehicle. That means whatever transaction we do at our level, the fund manager don't have to pay any tax at transaction level. And similarly for a client, until and unless he don't redeem, he can defer it taxation for as long as stay invested. And that's why there is no annual tax. Now, coming to the flexibility part of it. Today, mutual funds, they have done a great job over last 30 years and the category is more than 75 lakh crores, 75 lakh crores. But today, if you will see, if I'm managing a large cap fund, 80% of my portfolio has to be in those 100 stock. If I am managing a mid cap fund, 65% of my AUM has to be in that 101 to 250 stocks. So flexibility is very limited. And second, by default, most of the mutual funds are long only mutual fund, and at best they can take either a cash call or some hedge bets in their portfolio, like a balance advantage fund. You can hedge your portfolio, but you will not make money in a falling market. You can protect your losses, but you will not make money in a falling market or in a stock where you have a negative view. Even if it view go right, you will not be able to make profit out of it. In SIF, you have that flexibility because you have allowed to use derivative. In mutual fund, use of derivative is still there, but only for hedging and rebalancing purpose. Here, you are allowed to use derivative for taking exposure also, and that exposure can be naked short exposure. So that means not only you will be able to protect your downside, you will also be able to make profit if your view go right. And that feature right now was available to an AIF where they can take directional position. They are allowed to go up to 200% on gross exposure. That means AIF can still take leverage. Mutual fund and SIF, they are not allowed to take leverage. The best part of SIF is you are getting best of both of the world. Your entry size is not that big like in PMS or AIF. Ease of operation, transparency, everything of mutual fund is still available to you. And taxation, which is the biggest advantage of mutual fund, is applicable to SIF also.
So in the underlying, in the SIF, what kind of underlying asset is there? Can they also invest in the, much talked about, much hyped, the private equity space or the infrastructure space, debt or alternatives? Over to you on that.
No. So as I said, SIF is just an extension of mutual fund with some
Okay.
additional feature. Otherwise, asset class wise, we can invest in equity, which is listed equity, like a mutual fund, fixed income, like a mutual fund,
Sure.
gold, silver, REITs, invest, depending on which product you are talking about. But investment wise, we can invest only and only those assets which are allowed for a mutual fund also.
Now we talked about the benefits. What are the key risks as well? Let's talk about that associated with investing in SIF.
I think the biggest risk is the flexibility which we have got right now in
Okay.
mutual fund because it was tightly regulated. Your expected outcome was within the, you can say, category approach. Here, as I said, client will be coming into equity long short fund. We'll just take example of one of the category, which is
Sure.
equity long short fund. Now, equity long short fund is defined as 80% minimum has to be in equity. That is the single line definition of equity long short fund. Now, 80% always have to be in equity. As a fund manager, I can choose to run 80% large cap. You can choose to run 80% micro cap. Someone else will come and write 80% small cap. Someone will come and do 80% arbitrage. And that is why you will see the amount of difference in our portfolios and expected returns can be huge. That's why you have to actually study each and every category. You cannot just look at the name that it is equity long short or hybrid long short and invest blindly. Because as I said again, unlike large cap fund where 80% will be into similar 100 stock, here that 80% can go anywhere. And that's why you have to deep dive into each and every strategy. Second, all the risk associated with derivative, though it is just 25% of our portfolio, but if you are not utilizing it properly, can be a double-edged sword. Your longs can still go up and your short can still go up and you will lose money on both the end because you are underweight on long position and you have taken 25% directional short. So in a bull market, both can backfire for you. Third, as I again mentioned in the beginning, fixed income investor have got some leeway because our limits have increased on single issuer, whether it is AAA, AA, or a single A. Now that again I said is a double-edged sword. Sometimes concentration helps you, but sometimes concentration is also risky, as we have seen what happened with some of the issuers in 2018. So if that kind of situation happen, the limits are much higher, and if someone take that full exposure, the downside can also be significantly higher. So that is something again you have to look at individual AMC to AMC that how they are trying to utilize this flexibility given to them in a proper manner so that your risk goes down and not other way around.
All right. Well, on that note, Bhavesh, thank you so much for giving us such a clear lens into how specialized investment funds work and where they fit into the Indian investors toolkit. Well, to our listeners, I hope today's episode, helped demystify the idea of SIFs and gave you a practical framework to think about this emerging investment category. Well, that's been the Golden Thumb Rule. I'm your host, Kshitij Anand. Do like, share, and subscribe to the channel. Thank you so much for your time, Bhavesh.
Thank you. Bye.